Dear viewers, today we'll discuss about the level of interest rates, and I am Dr. Sharat Khandaka. So when we'll be discussing about what is an interest rate, so the interest rate is a rental price of money expressed as an annual percentage of the amount borrowed. So for the borrowers, interest rate is the penalty paid for consuming income before it's earned. So because for the borrowers, they haven't earned the money yet, but they're consuming it, so they're borrowing the money, so they have to pay the interest as the penalty paid for their consumption before it has been earned. And for the lenders, interest rate is a reward for postponing the current consumption. So they're not using the money now, but they're postponing their consumption, and they're hoping that in future date they will consume it, so it is a reward for them. And always remember that the interest rate is on annual percentage of sum. So the real rate of interest, what is the real rate of interest? So the fundamental determinant of interest rate is the interaction of investment and the savings. So for most of the people, they prefer consume goods today rather than tomorrow, which is a positive time preference. So think about, you have $100. If there is an option for you that whether you want this $100 in today's term or after 1 year, which one would you prefer? Generally, the people prefer to receive the money today. The reason behind it, in future we do not know what will happen. There are lots of uncertainty in the future, and the money will lose its value. So people will always have a positive time preference. So the equilibrium interest rate is also called the real rate of interest. This is the fundamental long run interest rate of an economy. So what are the relationship between investment and the interest rate and the savings? So for the investment, the higher the rate of investment, the more likely producers are to undertake a particular investment. At a higher interest rate, few business projects can earn the rate of return required by the investor. So what does it mean? So at the higher interest rate, people tend to borrow less money because the borrowing becomes very expensive, and a large part of the money will go towards servicing the debt. So at the higher interest rate, fewer business projects will run, and the vice versa. At the lower interest rate, the higher the demand of the capital. So at the lower interest rate, people tend to borrow more money, and the business activity will expand. So that is the relationship between the investment and interest rate. What about for the savings? So most people, they prefer to consume the goods today rather than tomorrow. However, if the interest rate is very high, then people will tend to consume later and save for tomorrow and save for today. So at low interest rate, most people will postpone very little consumption for saving, and vice versa. So when there is a very high interest rate, people will think that because there are lots of incentive of saving the money because they will receive a reward, they do not want to consume today, but they want to consume at a later date. So this slide is showing the interest rate around the globe. So there is a question: what is the current interest rate of your own country? So this is your task. Find it out now and look into the Australian interest rate. How does it differ? What is the interest rate in major European nations and the USA? Find it out. This slide will talk about the interaction of saving and investment. So if you look this slide you'll find it out on the left hand side, which is the interest rate, this part, and the right hand side, this line is basically saving and investment line. So let's look at to the investment first, which is this line. This is the right hand slope. When the interest rate is up, so here this is you want interest rate, very high interest rate, then the desired investment is the minimum. When the interest rate is declining, if you look here, then the desired investment is more. So the more interest rate is going down, the desired investment is actually growing. So this is the line. On the other hand, the saving and investment, when the interest rate is low, people tend to save low or very minimum amount. So if the interest rate is here, people tend to save less. However, as the interest rate is going up through this line, you'll find that the desired saving is going up. So this is SS, which is the desired saving line, and this is II, which is desired investment line. And here is the equilibrium point, where this is the point where desired saving and desired investment match together or cross each other. So this is the equilibrium point. Now this brings us about a theory called the Learnable fund theory. So a theory that may be used to explain shorter term movement of an interest rate to the learnable fund. According to the theory, interest rates are determined by the demand for and supply of learnable funds. SSU is the supply of learnable fund and the DSUs are the demander of the learnable fund. So the learnable fund theory stated that the supplier of the learnable funds includes consumer savings, business savings, federal government budget surpluses, state and local government budget surpluses, increases in the money supply by the RBI. On the other hand, the demander of the learnable funds includes consumer credit purchases, business investment, federal government budget deficits, state and local government budget deficits. So if you look at the supply side or the suppliers, consumer savings, so we save for the future because we are unsure about the future events. So we want to save for the future. For example, if you lose a job, how you're going to survive? In Australia, people can survive only about 2 months if they lost a job. So that's why people tend to save money. Business savings. So business want to save the money, and sometimes they also want to do the retained earning. So that could be the savings. They do also have different types of reserves. Federal government budget surplus. Now this is an interesting thing because nowadays very few Western government they do have budget surpluses. However, few years back, Australia is one of the only nation in the world, out of the developed nation, they do have budget surpluses. And the demand of the learnable fund includes, as you know, the business investment, federal government budget deficit. Now this is a very common situation as most of the governments nowadays do have the budget deficits and state and local government budget deficits. So let's look at the learnable fund geometry. So in the left hand side is the supply line and the right hand side is the demand line. So here is the interest rate and the learnable amount of learnable fund. Here is the interest rate and the amount of learnable fund as well. So in this slide is showing the equilibrium rate of interest. So this is the demand line. So if the interest is high, the demand of the learnable fund is lower, but if the interest rate goes down, the demand is higher. The same way, when the interest rate is down, the demand of the loanable fund is, so supply of the loanable fund is less. When the interest rate is up or going up through this line, the supply of the loanable fund is actually higher. And this part is called the equilibrium rate of interest, or this is the point where the supply line and the demand line will meet each other. However, to the next line, what we can see, which is an interesting scenario. So it's called the frame D, the effect of an increase in the supply of low-level fund. So if suddenly in the market there is an excess supply of the fund, then the equilibrium point of the rate of interest rate will change and set to a lower point. So look at this figure now. Previously, the RO is the equilibrium rate of interest. However, an external force puts some extra money in the market. Think about government issues lots of Commonwealth government security. Because of the lots of Commonwealth government security has been issued in the market, there's some extra money to the government, and this money passes through the banks. This excess money will reset the equilibrium rate of return to a lower point. So this is the excess supply, SL1, excess supply in the market, and then pushes the equilibrium point. So equilibrium rate of interest rate will set to a much lower point. Now, can you find a real life example for that? Think about the US GFC, how the global financial crisis impacted the whole world, and what are the main reasons of the crisis. Was there anything related to this? So this is something that you need to think. Now this slide is discussing about the price expectations and interest rates. So changes in the price level affect the realized rate of lenders, so change their lending behavior. Changes in the price level also affect the cost that borrowers must pay for this loan. The loan contract must incorporate the impact of expected changes in the price level to avoid unwarranted transfer of purchasing power between the borrowers and the lenders. So what is the Fisher equation? So that brings us a Fisher equation. The Fisher equation. The nominal interest rate is divided into two parts. The real rate of interest that exists in the absence of the price changes, and the expectation component that capture the expected percentage of changes in the price level over the life of the contract. So that can be expressed in the following Fisher equation. So small I equivalent to R plus changes of the price level. So where I is the nominal interest rate, so the nominal interest rate is equivalent to R is the real rate of interest plus changes in P, or this is the expected annual percentage of changes in the average price level in the economy. Now remember that the equation uses the expected percentage price level changes, not the observed inflation. So when we're talking about the expected price level changes, so the inflation could be a component of that, but it is not the fully inflation. Second, the expected changes in the price level may be positive, negative, or it could be constant. And the third is the nominal interest rate is the rate of interest actually observed in the financial market. So realized rate of return. The Fisher equation implies that the possibility the actual rate of return on a loan contract will differ from the nominal rate that was agreed to. So the real rate of return is expressed as R equivalent to I minus changes in P. So R is the real rate of return, I is the nominal rate of return, minus changes in the expected price level. Realized rate of return. So If the actual inflation is higher at the end of the loan than the expected inflation at the beginning, the lender will have lower realized rate of return. So let's look at an example. For example, that you want to take a project and your project uh, expected return has been based on the projected inflation. However, when you are completing the project, the inflation rate goes up. How it is going to impact your rate of return at the end of your project? So as the inflation rate goes up during the project, during the life of the project, so some part of the money has gone towards the inflation. So your realized rate of return has decreased. So this means that there has been an unintended transfer of purchasing power to the borrower, and that is called the realized rate of return. This slide shows the realized rate of return of Australia from 1979 till 2008. So this line is the 3-month T-bill and this line is the realized rate of return. So you can look, the realized rate of return is always lower than the nominal rate of return. Forecasting interest rates and economic model. So economic modeling is one approach to interest rate forecasting. Now economic model predict interest rate by estimating the statistical relationship between the economic variables and the level of interest rate. So it determine that how the economic variable is affecting the interest rate. So when the economists are actually forecasting the interest rate, so they also look at to the flow of fund and the pressure point. So the flow of funds data shows the movement of savings through the system. So how through the system the savings are passed to the deficit units, and the analyst examine the pressure point at which the demand for the fund exceeded the supply of fund, and that's how they're looking for the interest rate forecasting. Now the Reserve Bank of Australia is looking for the different types of forecasting of interest rate models. Now there are different types of model that uses across the world. For example, inflation targeted model has been used by different nations including the New Zealand and England. However, the Reserve Bank of Australia relies on a single equation model rather than a large scale of macroeconomic variables. For example, the different types of macroeconomic variables that can impact the interest rate might can include the inflation. The other factor that changes in the price level could be the unemployment rate, could be the exchange rate. So these are the independent variables that can impact uh, uh, the interest rate. However, when we're talking about the RBA model, it is basically a single equation model. In each equation, which deal with the various economic components, the parameters can be adjusted to examine the impact of changes on the various component into the feedback effects. So this can be done as well. So how would the forecasting? So as we know, these models can be used. Either could be different types of independent variables model, could be single equation model. But how good this forecasting are? How we know that this particular model is good? How we know the forecasting the RBI is doing is an accurate one? Generally, the forecasting are quite good. However, it's not immune from any error. Actually, error is a part of the model all the time. Studies shows that the forecasts are not always consistently. Different types of research and studies shows that the forecasts are consistently accurate, so they're not always accurate, and over the long run period, error could be considerable. So we need to understand that We need to understand that the forecasting is not 100% accurate, so there might be some error on it. So we need to take these things under the consideration, and then we need to analyze the economic situation. Hopefully you like this lecture. Thank you very much for listening to me, and I wish you a wonderful rest of the day. Thank you.